decided that they needed to cut back as well, and they eliminated the distribution system, and we all started wondering what was going to happen to long-term care. So very quickly, insurance companies got creative and put together a variety of different alternatives that somewhat resemble the traditional kind. And what I'm going to do today is I'm going to show you three of the more popular options. I'm going to make the statement now that in all the years that I've been involved in the consultative long-term care business, I've never found two needs that are alike. And my expectation for the time that I'm spending with you today is that my hope is that your realization will be that there are a lot of options. I don't expect you to know everything about everything by the time I'm finished, but my only hope is that you all will realize the importance of dealing with a consultative advisor, because if you happen to sit down or have ever sat down with someone to sell you long-term care and they don't ask you a lot of questions and they don't try to identify the best sources of assets for the product, then you're probably meeting with the wrong person. So the benefit of my relationship with PCE Insurance is that we are brokers and we represent all the carriers. So there's a very good chance that that the solution that fits your particular need can be satisfied by PCE Insurance Agency. I will also tell you that I've never given advice to anybody in my life. What I've done is I've asked questions, I've gathered information, and based on who you are, I've presented options, and we would make a decision together on what you felt was best. And that would be in the long-term care marketplace or anything else in the financial service industry. The one commonality of the three proposals and options that I'm going to show you is that your cognitive skills have to be good. So regardless of the kind of long-term care insurance that fits your needs, you will have to be able to pass a cognitive test. The medical information and the other requirements will differ by product, and I will go over them on an individual basis as we put them up on the screen. But the cognitive part is a must, and certainly no pre-existing condition. So if you've already been diagnosed for a condition that will eliminate you from long-term care, then unfortunately there's nothing I can do to help. So are there any questions at this point on anything that I've mentioned? Okay, great. So let's go into the first proposal, the first illustration, and this particular illustration okay. So this is as close to a traditional kind of long-term care policy as now exists. So when I say traditional, you pick out the benefit, you pick out the limit of coverage, you pick out the waiting period. So the waiting period could be 90 days, it could be 30 days. And all those criteria help in identifying what your premium is going to be. So the uniqueness of this particular product, and we're dealing, if you look up on top, you'll see that it's a a male, age 58. And then you see something called a cash benefit. Now, one of the something that we've all had to experience during the pandemic has been the issue of unfortunate deaths in long-term care facilities. So I'm happy to tell all of you that regardless of whatever product fits your need, there is now something called a cash benefit that is part of the product. And what the cash benefit does is it is provided that your doctor has identified that you qualify for a long-term care claim, the insurance company will pay you the benefit as opposed to the end user. So it's not going to go to the nurse. It's not going to go to the long-term care facility. It's going to go to you personally, and then you will have the option of what to do with it. Excuse me. Now, the other major issue with the old kind of long-term care was that, boy, I got a little frog, so bear with me. So the other concern that people who bought the old kind of long-term care was that the insurance companies had the right to raise the rates. So the insurance policies were guaranteed renewable, but the premiums were not guaranteed. So all of a sudden, somebody buys a policy and they don't need the coverage, and now they're deep into their 70s or early 70s, and now the rate is 2 times what they originally paid, and sometimes even more. So in the great wisdom of the insurance companies, they created a product that they knew wouldn't be needed early, might be needed later, because 70% of our population will need some kind of long-term care coverage. That's a national statistic. And now all of a sudden, people who are on fixed incomes at retirement now wind up with a 2 or 3 time expense for long-term care and can't afford it. So what the traditional policies put on their policy was an ability to buy a return of premium rider. And what that meant was that the benefit, regardless of how high it increased, if you never used your benefit or you didn't use all of the premium for your benefit, the balance of that money would be given to either you if you decided to cancel or to your heirs at your death. So what the traditional companies tried to do was to give you some relief from the myths and the concerns that people had on those old policies. The other thing that they created was a partnership deal. And what the partnership deal is a relationship that most states have today with Medicaid. Now, Medicaid does provide some long-term care benefit. However, in order for Medicaid to provide the benefit, they wind up taking all your assets, except for enough money for you to continue to either live wherever you live or drive a car. So for the most part, what the partnership program does is it gives you some relief in the event that you exhaust your long-term care benefits and now have to rely on Medicaid. So let me show you the example, Angela, if you can pan down to the policy limit. Perfect. Okay. So in this particular policy, there is a compound interest inflation protection rider, which has to be purchased in the event that you're interested in utilizing the partnership program. So if you look at the policy limit column, you'll see that the individual, the 58-year-old person who buys this policy, in 10 years, instead of 180,000 of benefits, now has 240,000 of benefits. And if he doesn't need the long-term care benefit for 20 years, then in the 20th year, if it's a 3% lifetime benefit, lifetime interest, then all of a sudden that benefit grows to $325,000, which means that the insurance company is on the hook to pay out $325,000. Now, here's where the partnership program comes into play. If you exhaust the $325,000 and you still have a long-term care need, and in most cases, it's been the dementia becoming Alzheimer's. Most other situations last no more than 3 years. That's the average long-term care situation. But I can tell you, I know situations where people are now alive into their 10, 11, 12-year situation with Alzheimer's, and the expenses to the family are exorbitant. So now let's say it's 20 years from now and you exhaust this $325,000. The partnership deal says that Medicaid will allow you an additional $325,000. So they're not going to take all your money. They're going to leave $325,000 that you can use for a better long-term care solution than what Medicaid offers. Now, I can tell you that the partnership program has been in effect in most states for about 12 years, and in some states, maybe 6 or 5. There are only 50 cases in the nation where the partnership program has actually been utilized. So, if in fact you're concerned, and, what most people do is they go to an attorney, they draw up a document, they create a trust, and they protect their assets in some way prior to a long-term care situation. In most cases, the solution is transfer your assets to your heirs or another family member who will be protecting that money, but it has to be done within 5 years of you incurring a long-term care situation. So those are the bells and whistles of the new traditional long-term care policy. There is no medical exam required. The qualification will be the attending physician report from your doctor and the medications you now take, plus the cognitive test. So if all 3 of those are good, you would qualify for this particular product. I'll leave it open for questions. Okay, great.
You had said about pre-existing conditions. Could you qualify that a little bit more as far as making you ineligible?
Well, it's really whatever your doctor's report identifies. So if the underwriters feel that your condition is such that that they would be concerned to give you a policy, then that would be the case. So I can't actually describe all the possible conditions, but in most cases, it would be physical issues, it would be heart history, it would be diabetes, but again, what we do is we take your information and we go out to the marketplace. So, a good agent would take whatever it is that they see, and then they would explore it prior to getting the doctor's report. So, we do a fairly thorough review to make sure that if you do have a pre-existing condition, we would go to the carrier that doesn't look at it in the most discriminating manner. And to go further into your question, carriers look at different medical histories in different ways based on their history of that condition. So did that confuse you enough?
I'm sorry?
I said, did that confuse you enough?
Well, I like a condition like asthma or those kind of things. Would that be pre-existing and eliminate you? In most cases,
it would depend. So again, I don't want to say it's going to eliminate it, but it would be based more or less on the level of asthma, how long you've had it. I would say if you just got it, or you got it in your older years, that it would probably disqualify you. If you've had it for life and you're under, you've been under treatment and medication and it's controlled, then you have a much better chance of getting coverage.
Okay, thank you.
Okay, you're welcome.
Alan, can you tell us how the return of premium works, when somebody's eligible for that, and just kind of give us an example of when the insurer could take out the premium if they wish to do it?
Well, I mean, let's say that in this case, this policy, which looks to be quite loaded with benefits. So a policy like this one is about $3,000 a year if you bought it at age 58. Okay. This particular individual was preferred. So now let's say that, 7 years later, the insurance company gets the okay from the state to increase the premiums by 10%. So now whatever that premium is also guaranteed to be returned to either you or your heirs. So if you decide at any point in time that that you have the policy, and most people don't cancel insurance policies, long-term care policies midstream, unless there was a better alternative for them. So that return of premium would be available. I mean, the insurance company would probably be happy to give you your money back at that point in time because they had no risk and your risk becomes greater. So you would get whatever the premium was that you paid in, including the increase. If there were 2 increases or 3 increases, you'd be guaranteed all that money back. If you never used the policy and died and you paid in, in this case, let's say 58, let's say on the average you paid in $6,000 a year for 40 years, the insurance company will write your family a check for $240,000.
Thank you.
Okay, you're welcome. Okay, let's go to the next example. So this one is probably the most popular product that's on the marketplace today, and it's called a linked benefit or a hybrid, and it's a kind of a cross between a life insurance policy and a long-term care policy. So think conceptually here, please, and let's look at what the benefit is. So the benefit on this particular policy over the lifetime of a 5-year, $4,000 a month benefit, the insurance company is offering you a total of $240,000 of benefit. Okay, so 4,000 times the number of months times 5 is $240,000. The concept, however, is that this long-term care benefit is getting paid out of your life insurance policy. So you may say to me, Alan, that's impossible because it looks like the face amount of this policy is $96,000. How the heck is the insurance company going to pay $240,000 of benefits plus whatever the inflation factor increases that policy to? How is that coming out of $96,000? Well, the insurance company is your partner on this product. They've already done their actuarial studies, and they think that it's a prudent move on their part to say to you, if you've exceeded that $96,000 death benefit, we will pay the balance. So it's coming out of the insurance company, not out of your pocket, okay? And in addition, we're going to give you a guaranteed minimum death benefit of $19,200, even though you've exhausted that $96,000 death benefit. Okay, so it's once again actuaries and insurance investment people who believe that by getting the money up front where they can reinvest it, that it's a win-win for them and it's a win-win for you. Okay, so in this particular illustration, the client has chosen to pay for 10 years. And the premium for this kind of a policy with this benefit, which is a 5% compound and a return of premium guarantee. So if you look at the scheduled premium, it would cost $12,253 a year for 10 years, no payments thereafter, none whatsoever. If you look at the third column where it says net death benefit, you can see that the net death benefit has grown to $122,530, which means that whatever your premiums are, which is after 10 years to $122,530, identical to the net death benefit, that in the event that you decide to cash in your policy, they will give you $122,530 back. Okay, so you get all your money back if you decide to cash it in. If you continue to look further down to the next to the last column, you will see that your monthly benefit is growing each year from $4,000 to $4,200. In 10 years, the benefit is now $6,205. In 15 years, the benefit is $7,920. So the reason why I picked out the 15th year is because you're almost double the benefit over that 15-year period, and nobody's asked you for any more money than that $12,253. Now, I will say to you that if you could pay less years, if you could pay 5 years, or you could pay one payment, that the insurance company would give you an additional discount of up to as much as 25% if you paid in one payment. So what the insurance company is saying is, if you have money that you have not identified for any other retirement need or travel need or health need, and you want to put that money into a long-term care policy, then it would probably cost you about $100,000 or maybe even less one payment, never another payment again. And the insurance company is giving you that benefit because they think they can invest that money better. So if they got all your money in one payment, then what they're doing is they're protecting that long-term risk that the actuaries say makes the most sense for them. Okay, so once again, when I mentioned to you that this is a win-win for both the insurance company and for the buyer, it truly is. The other thing is that the entire benefit, as long as your doctor says that you are unable to perform 2 of the 6 daily living functions, that the insurance company will pay you every month a check for whatever the amount is at that point in time in your life. And you can use it for whatever you wish. If you feel like you can hire a nurse and stay at home, you can use whatever money to hire a nurse. If you decide to have one of your family members take care of you and not have any outside expenses, you can do that too. So they're not going to check how you spend your money. All they're going to check is that the doctor's report is valid and that you are qualified for a benefit at that point in time. So the link benefit is pretty unique. Obviously, you're paying more money and you're paying it over a shorter period of time, although I will say that Nationwide, which is the company that is shown here, they will actually let you pay over your lifetime. So I can tell you that the cost per year over the long term of the policy will be more than the $122,000 that you're paying for 10 years, because the insurance company is giving you the opportunity of spreading your payments, and by doing that, it's mitigating their ability to reinvest the money that you're paying. So, but they've chosen to compete with the traditional policy. So you've got a hybrid of a hybrid where you can pay over your lifetime, or you can pick and choose the number of years. If you say, show me 20 years, I can show you 20 years. And the premiums will be less each year, but they will be more than what you would have paid in 10 years, 5 years, or 1 year. I'll open the floor for questions.
Alan, my name is Josh. Are long-term care benefit payments taxable? Like when I get that every month, is that taxed?
It's absolutely not taxable. And when I get to the third proposal, there are even more bells and whistles in that one. But the fact that you brought up the word tax, let me mention that there are tax deductible benefits to these policies as well. The traditional policy, there's a chart that your accountants should be aware of, and the amount of deduction is available in increments based on your age. So if you were approaching 60, your tax benefit, your tax deduction would be somewhere between $2,000 and $4,000. Now, it is lumped together with that $10,000 tax deduction that you have on medical expenses. So if you've already incurred $10,000 in medical expenses, which are deductible, then you can't include the long-term care benefit for tax deduction. On the hybrid, it is possible to actually break down the the cost of life insurance versus the cost of the long-term care benefit. And then whatever that long-term care benefit is from a premium standpoint, you would have that same individual tax return benefit. So there are not only tax-free benefits, but there are tax-deductible benefits. And if there are any business owners out there, there are ways of making the hybrid policy kind of like a key person policy for any of your key people. But in order for you to benefit as the owner, it would depend on the kind of corporation you have. So I don't want to get too technical, but I can tell you that if in fact you are a business owner, then we can help you with the tax ramifications of long-term care as well. I can guarantee you that the simplest question will get a long answer from me. Unfortunately, it's just the way I am.
Thanks, Alan.
You're welcome. Any other questions on the hybrid? And by the way, there's no reason why you can't mix and match here. We have several clients that buy a little of the traditional and then buy a hybrid. So, you know, if they're very interested in the partnership program, or they feel like they're more comfortable with the traditional because of the tax deduction, then, you know, we can help design a traditional plan. And let's say you have 30,000 or 40,000 that you don't think you're going to need down the road. You can put that amount in a lump sum, and we will be able to tell you how much benefit that amount of money will buy you. So you can kind of piecemeal your coverages together. So now let's assume that that we meet with you, okay? And unfortunately, we come to the conclusion that medically, you're not going to be able to qualify for either the traditional or the hybrid plan based on your health. So there's a company that is extremely creative, and what they've done is they've created a product called Annuity Care. And what Annuity Care is an income provider, which means that you can't outlive it. You know, annuity is kind of a misnomer by this time in our lifetime, because, you know, annuity connotes that you get a payout for a certain number of years. In reality, all the annuities today are more of an income that you can't outlive. So if you live to age 100, if you live to age 120, you would continue to get that payment each and every year, or, you know, for as long as you were alive. So the criteria for qualification for this particular product is, can you answer 5 fairly simple questions? In reality, you can't have already been diagnosed for a long-term care situation. You can't have AIDS, but those are really the only qualifiers. So I've not come across anybody thus far who has not been able to qualify for this particular product. Now, in this case, both the husband and wife, who were age 60 and 63, both of them could not qualify for long-term care. So It so happened that they had $100,000 that was not allocated for retirement or any other needs. And I tell you, I am so adamant and vigilant about making sure people understand that if in fact they think that 2 years, 3 years, 5 years, 8 years, that they're suddenly going to need this money again, don't do it. I do not want to see these policies blow up, and I don't want to see anybody lose any money. So it's truly a product that is there in the event of. Now, it's a very interesting product because you can put both qualified and non-qualified money into this product. So when I say qualified, it's money that has already that has been in some kind of an IRA, a 401k, a SEP plan, any plan where money has not yet been taxed, nor has the accumulation been taxed. So what America says is you can even give me non-qualified money, and you can give me qualified money, but not together, of course. So let's say you've done the right thing over your lifetime, and now you've got, well over $1 million in accumulations in a 401k plan, and you're now retired. Well, you now have the predicament of having to pay tax on a lot of money as you take it out, starting at age 72, when the government requires you to start taking money out. What this plan says is you can move no more than 30% of your qualified money into this program. And when you take the money out, because it's a long-term care benefit, it's not going to be taxable. So it's one of the magical ways that you could move money that would have normally been qualified and taxed into a plan that now could be paid out to you on a tax-free basis. The same thing would hold true for non-qualified money based on how much can you put in. You can't put in more than 30% of your non-qualified assets. Okay? So let's look at the product. So you would say to yourself, well, if this is the last resort, it's a pretty darn good last resort, provided you had this kind of money. And remember too that you can be healthy and buy this as well. So you can choose a portion of this and a portion of traditional. You can choose a portion of this and a portion of a hybrid. So you've got the flexibility, provided that you have the money, and you can qualify for as many of these products as you feel will fit your particular need. There are many times where the husband can qualify and the wife can qualify for either a traditional or a hybrid. The fact that they are married will get them a discount on the benefit that they wind up having to pay for the insurance. Okay, so if I was married and my wife bought a hybrid, she would pay less than somebody who was not married. The fact that I am married and I buy a product in the annuity care market, I would get a better benefit, a discount for the fact that I am legally married. So there is a benefit to being married at this stage of our lives. That was just a joke. So if you look at the illustration, you're putting in $100,000, and this couple gets a joint benefit. There is an inflation accumulator, okay? So they're putting in 100, and unfortunately with this product, they are not going to get all their money back if they don't use it up. They're only going to get about 90% of the money that they put in if they either decided to cancel it or they died and didn't use the money. Now, if they died and used 40,000 of the money, then their heirs would get 50,000. So they would always get whatever that accumulated value is in that column, whatever the accumulated value column shows. So in this particular case, if you lived to age 100 and never used the plan, I think you'd probably be happy. And somebody will wind up with $89,832. Now, just like the hybrid, your plan is going to continue to grow. So if you don't use it, if you look at the far right-hand column, you're looking at 5-year increments here. So if one of you needed the plan and needed long-term care, then the annual amount of benefit that you would get would be $36,156. However, if you had purchased that continuation of benefit rider, then the increase by the 5th year would be $43,920. So now, if both of you needed a long-term care benefit, you would each get whatever $43,920 would be on an annual basis. If you needed long-term care and your wife never used it, you would be able to use her benefit. So if God forbid you wound up with dementia and it grew into Alzheimer's, you can see that in this particular case, in the 20th year, there's a benefit of $91,308 that would be available to each of you. So the person who has the Alzheimer's, if they're still alive, they would now be able to tap into not only their benefit, but their spouse's benefit. So it's a unique product. It fits unique needs. But, you know, as you probably can gather, it may very well have some validity in many, many cases. There are many people today who are looking very closely at their own insurance policies, their own long-term care policies, and provided they can qualify for a new plan, we can show them a better way to take care of their long-term care needs. This particular product, the annuity care, even if your health has changed and you couldn't qualify for a regular plan, you could qualify for the annuity care. Now, unfortunately, the old policies did not have return of premium. So you'd be out of luck from the standpoint of getting any money back. But if you happen to buy a policy that had the return of premium, then 10 years from now or 15 years from now, you could very well cash that in and buy an annuity care product if you felt that was more valuable to you at that point in time. Most of these plans will provide coverage up until 80. Because of the current pandemic, the policy that I showed you that was traditional will only write up to age 65. We do have another few products that will write up to 70, even during the pandemic. The hybrid and the annuity care, go all the way up to age 80. Questions? Okay, so I guess either I did a great job of explaining it or I lost all of you. But I normally do over explain, and hopefully you did get the general drift of the value of each of these products, depending upon your individual need. Any questions on anything that I've discussed so far today?
Alan, you hit on it a little bit, but can you talk a little bit more about the different avenues of care that are available today in these policies? It's not just for nursing homes, but also, you know, in-home care and other things to try and keep people in their home instead of necessarily having to go to a nursing home.
Well, as I mentioned before, Brady, that whatever the check is that you get, you can use it for whatever you want. Okay, so you know, whatever services you need, whatever medical services you need, you know, as long as it's tolerable to both you and your family to be able to stay at home. You know, you do have the flexibility that if, you know, at some point in time you do need to go into a facility for a specialty need, that you can do that. And, you know, and now the cash benefit that you get would be able to pay for that facility. So you know, it's not just home care, it's care in general, whether it be in an outsource or at home. I think most people would prefer to be taken care of at home, but, you know, there are situations where you know, the best nurses in the world are not going to be able to take care of some extenuating circumstances.
Thank you.
I hope that gives you the general overview.
Any more questions out there? There's just a few of us, so if you don't like that chat box, you can unmute your microphone and ask out loud if you want.
Alan, this is Josh again. So I have, so my wife and I are 40 years old, and she didn't hear this presentation. So, and I'm going to be a very poor substitute for you or anybody else who could explain this better. Are there resources online that you would recommend for kind of the layman's introduction to long-term care, or kind of some of the things that you've just talked about here that I could present to her or even go through again myself that you would recommend?
You know, there's material that each of the companies provide, but I would volunteer myself and one of the associates at the insurance agency to do the same kind of presentation for just you and your wife.
Okay, so the best resource really is to sit down with somebody and kind of walk through it personally. That's what I hear you saying.
I would say that is because you know, as long as you know, you feel that the consultative service that you're getting is appropriate, then I would always choose that. Now, you know, you can if you were able to tell us what exactly you would be interested in reading about, you know, we could pull you know, sales material from those particular companies, but you know, you never really get the full value from any sales proposals because the word sales is in it, you know.
Okay, thanks.
Yeah, I mean, policies, and you know, what gives you the most information is the proposal that's drawn up, because you know, you're looking at one page. The proposal is normally you know, as many as 20 or 25 pages, and it goes into the glossary of terms, a complete definition of what you're looking at. So if you told us what kind of proposal we might be able to get you, then you can review the proposal, and then we can, reconvene with you after you've done that. That's another thought.
Yeah, thanks again.
Okay, you're welcome. Okay, Angela, thank you so much.
Thank you, Alan. Thank you. It's a complicated subject, and I appreciate you breaking it out for us and giving us some history and all with it as well. So, and taking the time to spend with us this afternoon. Thank you.
Well, it was my pleasure, and I can just tell you that there are other options. I had up to an hour, so I picked the 3 that are most popular.
Okay, good to know. Good to know. All right.
Okay, well, have a great rest of the day. Be safe, be healthy.
And same to
Thanks,
you.
Alan.
Same to you, Alan. Take care.
Okay.
Bye, everybody. Well, I think that worked out just fine.
Thank you.
Thank you, Alan. Bye-bye.
You're welcome. Bye.